All right, let's dive in. Today, we're going to crack open the playbook of the legendary investor Benjamin Graham. We're going to cut through all the noise, forget the complicated charts for a minute, and build a simple but really powerful framework for putting your money to work, all based on his timeless wisdom.
But before we get to that, let me ask you something. What do you think is the single most dangerous part of investing? I mean, is it a big market crash, a bad tip from a friend, maybe a corporate scandal? And yeah, those are all risky for sure, but the real danger, it's something much deeper, something we all do every single day.
And this quote, it just nails the central paradox of investing. We build these incredibly complex, fancy financial models, all to predict the future, which is, by its very nature, completely unknowable. Our need for certainty, right, where there isn't any, is exactly where the biggest mistakes happen. So, to fix this, Graham said that every investor really has to master two very different jobs. There's the job of the statistician, and then there's the job of the fortune teller. And believe me, knowing which hat you're wearing at any given moment is the absolute key to success.
Okay, so job number one makes you a statistician. This is where you're analyzing a company's past, its profits, its stability, how much cash it has. This part is pretty straightforward. The numbers are right there for you to see. But job number two? Well, that turns you into a fortune teller. Now you have to predict future growth, and that's where we all get into trouble, right? We start relying on these complex guesses for a tomorrow that nobody can promise.
So, what do we do about this? This is where Graham's genius really shines. He created a system that draws a hard line in the sand between what we actually know and what we can only guess. It's this two-part valuation that brings some serious clarity to what can feel like a really fuzzy process. Think about it like this. Imagine you're valuing a Lego factory. Part one is totally mechanical. You just count how many Legos the factory made over the last, say, 7 years. You check their quality, you do the basic math. Honestly, anyone can do this part. But part two, that's where you need an expert. They look at those hard numbers and then they ask the subjective questions. Are people going to buy more Legos in the future? Is the management team any good? See? This is what separates the cold hard facts from the necessary but way less certain expert judgment. Now here's the thing. Not all companies are created equal. Some of them are incredibly vulnerable to attack, while others, they're like these fortified castles. So the key to finding a really safe investment is to look for its defense system, which savvy investors call a moat. A moat is really just a durable competitive advantage that protects a company, just like a real moat protects a castle from invaders. And it's simple. The wider and deeper that moat is, the safer your investment is going to be over the long haul. So what's the first type of moat? A powerful brand. I mean, think about Harley-Davidson. People don't just buy a motorcycle, they're buying into a whole identity, a community, a feeling. That emotional connection is something that competitors find almost impossible to replicate. It's an amazing defense. Next up, you've got monopolies, or just massive economies of scale. Your local power company is a perfect example of a monopoly. I mean, you don't really have another choice for electricity, do you? Or think about a company like Gillette. They can make razor blades so cheaply and at such an enormous scale that it's incredibly hard for some little startup to even think about entering the market. And finally, you have moats that are built on totally unique assets. Coca-Cola's secret formula is the classic example. It's a priceless and tangible advantage. Or you have businesses that are just essential. They can't be easily replaced. These things are powerful protective forces for a company. Okay, so the moat gives us a great way to think about quality. It tells you if a company is a fortress, but how do you know if that fortress is actually worth buying? Well, for that, the journalist Jason Zweig came along and updated Graham's ideas into a super practical 5-point checklist that any modern investor can use. This framework gives you 5 key areas to investigate before you even think about buying a stock. Seriously, think of it like a doctor's checkup for a company. You have to examine every single one of these vital signs. First up, long-term prospects. You've got to dig past all the marketing fluff and get into the financial reports to see where the cash is really coming from. And just as important, you have to scrutinize the management. Ask yourself, are these people quiet operators focused on running the business? Or are they loud promoters who seem more focused on hyping the stock price? Look, management will always tell you a good story. They have to. But their actions, that's what reveals the truth. As the old saying goes, watch their wallets, not their words. Are the executives buying more stock with their own money, or are they quietly dumping their shares while telling you to buy? That one action tells you everything you need to know about their real confidence. Okay, next you examine its financial strength. Simple question. Does the company generate more cash than it burns? Then you look at its dividend record. A long, consistent history of sharing profits with shareholders is a fantastic sign of health. And finally, check the current dividend rate. Is the income you'd get both attractive and, more importantly, sustainable?
So now that we know what to look for, it is just as important, maybe even more important, to know what to avoid. Every investment landscape is basically a minefield, and learning how to spot the red flags is a critical survival skill. Let's start with a company's growth habits and its management. You have to be really wary of a serial acquirer. That's a company that just buys other companies for growth instead of building it themselves. And like we said, watch out for CEOs who are promoters, where if you see a ton of insider selling, those are huge flashing warning signs.
And then on the financial side, some red flags just scream danger. Negative cash flow is potentially fatal. It means the core business is actually losing money. You should also be wary of a company that's addicted to OPM, other people's money. That means it constantly needs new debt or has to sell more stock just to keep the lights on. And please, watch out for pro forma earnings. Those are specially adjusted numbers that companies sometimes use to hide their actual losses. And this brings us right back to where we started. The more a company's value depends on these rosy predictions about the future, the more likely you are to see complex, confusing math being used to justify its price. And that complexity, well, it's very often a trap. The story of Sycamore Networks is just a perfect, painful example. It went public back in 1999 with a staggering $15 billion valuation, all justified by these complex forecasts. But hiding behind all that math was one simple, fatal fact. 100% of its revenue came from a single customer. And when that customer went bankrupt just 2.5 years later, Sycamore's stock collapsed by 97%. And this, right here, is Graham's ultimate lesson. Real, durable value should be easy to understand. If the reason for buying requires a PhD in mathematics to explain, it's probably built on hope, not reality. Simplicity is a sign of strength.
Now, just contrast Sycamore's messy complexity with Graham's beautiful simplicity. This chart shows his safety standards for bonds. There's no calculus, no wild predictions about the future. Just a simple rule based on historical fact. How many times over could a company's past earnings cover its interest payments? For an industrial company, that number was 7. 7 times. That's it. A simple standard that over 70 years of history effectively separated the companies that survived from those that failed. And that, really, is the ultimate lesson from Graham's playbook. The most powerful tool isn't some complex algorithm trying to predict the future, it's the discipline to focus on simple, proven facts, and the wisdom to always demand a margin of safety.